Welcome to the S&P 500 MMTs. We just had a very lengthy discussion, about 45 minutes, and we are talking about how to apply options, S&P index options, but understanding what the S&P 500 is doing and what is it correlated to, what are the equity relationships that made the S&P once again bounce like a rocket up the 200-day simple moving average. And what I'm going to do is just move the chart over here for a minute, and I'm going to talk about when we had the bull trend, what has happened is we had a short-term oversold to an extreme overbought market here at 93.94. Then our pullback was to a major neckline right here, which is roughly right below the 1300, okay, 1299.36. That's where we broke out and we pulled back. So there's your bull summer rally, there's your pullback, and there's the counter trend. But notice that we start reversing and taking out this last big up day in the S&P, and we sold right through all the daily moving averages right here. And we have live video analysis. Just go back to this week or just type in S&P 500 index and you'll get all of it. As we were going through this week, all of us here during our trading week, and the debt ceiling and all the contagion and everything is part of the down move, and the market's pricing in everything. But we got to the 200-day simple moving average like we did here, a higher one here and a higher one here. And when the simple moving average is ascending in value, meaning that over here I gave Ken Flagg, the 200-day was at 12.57, slightly above the test. You were at 12.64. That meant that strengthness was building off of that bottom. So when we got to that pullback, this value of the 200-day simple long-term structured moving average would mean that there would be a breakouts that follow that. And when we got through here, that moving average kept rising in value to 12.66, which meant that as it was rising in value, we were getting stronger in the breakout values. And when we got up here, the 200-day simple moving average was at 1271 up here at the time. So we can see how overbought we got, but the point of it is that this bull trend has a double left reversal. It has a reversal from its bull rally, short covering squeeze, summer rally traditional time, with the pullback here, and another major reversal that goes 1 day, 2 days, goes through the moving averages. On the third day, 1 day, 3 day, and then on the 5th day, it landed at the 200-day simple moving average. And what was it that made it bounce off the moving average? We already know. It was the S&P 500 stocks in here that were the biggest leaders. Was Apple, Priceline, Amazon. But look at the ranges in the S&P, and you have to know what names in the S&P were the biggest part of that movement at that 200-day simple moving average, because when Monday comes along, it won't be the same stocks. Priceline was the biggest one in here. Right now it's kind of froze up. Priceline was $16.87. PCP was $7.64. That's what this means. That was the weighting at that support level. Those stocks were bought because it's 500 of them in there, but it was only so many of them that had the best price ranges off of the bottom. That's how you bounced there on the S&P. And you have to know where the biggest leadership stocks are, because they're not going to be that way come Monday. You hear me? Because they're not. And I just want people to know that it's very important that you learn what stocks are the biggest price movers that was part of that support level, because if you understand that, then you can get over here now and start trading these index options. I'm showing the 1320 put right now. We have them all here. So when the 1320, when we gap down to test that 200-day moving average, it was time to sell out of the high up there, because we got support on that 200-day moving average, and we had those leadership stocks that were making the move, so we knew what would move the S&P 500 off the lows across the board. And by understanding where the broader movements are, that's how we learn to trade that powerful strength. And those names that are doing that gives us the ability to sell out here on the puts. So when that thing came down, the $1,300 call right here, MMT, 1950, there was a great move. When that hit that support, the contracts close at 26. They dropped the bid over here in the S&P 500. There's a special way to learn how to trade it. You've seen me trade it time and time again. And when you got that support and those equity names were bouncing, that was making that bounce, and we put the low in, and you had a good entry and exit using an $820, $1,300 call that was slightly below the money. And what do I mean below the money? Below the market, meaning they were out of the money. And basically, the 200-day simple moving average was 1284. And this trade has worked all year on every, it worked for that pullback here that we called at the end of April, 428. Go to stockmarketpending.com, type in indexes and see for yourself. And when we finally got down here, this trade has worked. And it's been the key leadership types of stocks in the S&P 500 that make huge intraday moves that start this short squeeze, and these rallies are failing because you got the first pullback and you didn't make another higher high, and you're not consolidating the broader rally movement. 1 day, 2 day, 3 day, 4 day, 5 day. Here's 7, and then here's the 8th day, the 9th day, the 10th day of 2 trading weeks. You were starting on the 10th day of this trading zone on 2 sets of, so it was 5 trading days in a week, and it was a second set of 5. That this day right here on 7/11 now, that the S&P came down, got below its 10-day simple moving averages, got to the 40-day, and then popped up. But notice that we're making lower lows from the last low to the 200-day moving average. And when you get support here of that magnitude, it will be the third test in 2011, rising 200-day simple moving average for this time frame, where that trade has worked well. And what were the key individual stocks in the S&P 500 that drove it higher? So by understanding that, that tells you how to trade this. And there are really good days to get these wholesale. Once you buy them, you're automatically in control to offer out. That means the public have to buy your contracts. So the S&P 500 is approaching a death signal called a sell signal. Last time you had a sell signal right here, this was back on what day? Just exactly on 5/31 of 2011, where that big daily down bar, and you went right through the moving averages here, but they were going down. These moving averages here are starting their first phase, like the blue and the red line started over here, and then they progressed, and the more that they separate, the weaker the downside is going to be, and you would know to be on the put side of the S&P 500 index options. Okay? And what that means is that they have huge trading ranges, and if you know how to trade them, well, you can do extremely well with them. And when we came up here, here's a put option that could have been bought. What this put option down here got as low as $26 a contract, $25.20. I'm sorry, right here, and that date was on 7/21. When the market was reversing and selling down in the S&P 500, these were breaking out, and my friends, they went to $70. So do the math. If you were buying them at $26 a contract, say you bought 3, take 70, divide, or not divide, but minus that, and you'd have a big, huge move. And when the markets were reversing over here on the S&P 500, so when we were up here reversing right up here at the 13 in the original phase over here, this put option at the strike price, which is 13.50 here. We'll overlay these two together. So here, Let's put the 1350 in here so you can see the relationship. 1350 put, trade management now, MMT. Okay, now, up here now watch. On that day, 7-7. On this day down here, let's see what the date is. 7/21 is when that contract was put in the bottom, and this is 7/22. And they started to move up in value gradually. The lows, there were $3 off the original entries over here. So those were the dates there when you had put in this particular cycle. There was another cycle over here. That's a different cycle though. But when we rallied on up here to the 1350 level in the summer bull rally, and we started to have corrections over here. This correction right here is that move, and this correction here is this move. So you've had the put side of the market in the S&P within the trend structures. You've had one breakout. What a nice trade. Then you had another breakout right here. So reversal 1, you go higher. Reversal 2, you go higher. Okay? When we were rallying up there, that's when they came down in value. Okay? That's when you got to the low here. So basically, by having the constructive risk management and price action and the right strike prices here at failure, you can make a lot of money when the S&P goes down. And you've had the problem with the bull rally, even though that you got support with those names in the S&P 500. The problem is that if you take a look right here, 1 positive, 2 positive, 3, 4, 5, 6 good big positive bars, but you've got 1, 2, 3, 4, 5, and you can count that 6. You've got more distribution within the bull trend, and you want to see less distribution, meaning contraction, so that you break the higher highs. You don't left. So the put side of the market on the S&P rallies here for the summer have been exactly right on the money. So I fell at 1350, and I fell this contract here at the time, or this movement here at the time was on 722. You're at 1343. That put this contract here $7 in the money, or below the market, out of the money at that time in that reversal. So what I want you to understand, corrections and put options and value, by understanding the key core component of the S&P 500 and how to structure S&P 500 index put options is the thing. Now, there are other trade management scenarios that will follow on Saturday's training, and I can tell you right now, I can go to my turbo option MMT, okay, and I'm going to look at some below the market. So I know 1385. I'm going to look at a call and a put, and we'll do this tomorrow, but we'll go to the 820, and I'm going to look below the market. And what I'm going to do is I'm going to look at the 12, because if we sell through there, what I'm going to look at is a 1275 put below the market. I'm also going to want to know where that 1260 put is below the market. But then again, vice versa, in a shorter MAC world, I'm going to want to know how wholesale, that 1330 call, volatility for the upside, they get the debt resolution and they get that. Well, I'm looking at buying that 1330 call because it was inflated up here, and when call contracts on the S&P got too inflated up here on 7.7, they were going to come down. The high here 40, the low here was 12. Then the call, when the S&P rallied on up, now when the S&P broke out here, these contracts could have been bought right here, and they could have been bought on 627. As we said, we were doing this. We were actually trading that contract at the time. When and you could have bought it at $8. Okay, they went to a high of $40. What a nice trade! And what was it tied to, MMTs? Because you were there when we were doing them. And what it was tied to was this rally here at the 200-day moving average. And now, for volatility reasons, if they come out and do the debt ceiling and, hey, this bounce is going to hold, the 1330 call where this last major reversal was right here. See where the high is right here. It's they opened at 1325. The high was 1347 and the low was 1325. So we would look at this 1330 call at the wholesale, so we could have some call contracts up and out of the money. And then on the very same side, MMTs, because these are wholesale, they're not inflated anymore, and we're at support here. Now, on the other side of that, though, is we got to look down below the market. That if the S&P is going to keep going lower, is where this put option is. The put option low was over here, and basically that was $6.37, and now it's up here. And it's somewhat inflated, and it's at the high today was $27. It already made the move. 1 day, 2 day, 3 day, 4 day, 5 days, 6 days. That 1275 put right here, when we had that reversal right here, that was a monster trade. Buying 10 contracts down here like we always do. My friend, the low was 630, so what? So you got in even at $7. You just made the high here at 27. If you had 10 contracts, that was a $20,000 trade using the index options. Yeah, at when this reversal happened, knowing when the reversals is going to happen. Now this is inflated, okay? So we know that the 1275 put is inflated, and we also know though that once again, up and out of the money 1330 call is in the beginning phases of its deflated zone. The last lows over here were 815. We traded those. Now the low today is 850, Rick Goley, and they're back in the deflated range. And the reason why, and set alarms on them, we'll do that after the video, but the reason why we look at how to square volatility risk is that these are getting into the wholesale area, so that upside movement or pre-market future gaps that go way up in the S&P will pop these way up there. Okay? We know that in the shorter macro trend management at support level here, that these contracts got support today at that 200-day moving average on the S&P, and that the low today for the trade was 8.5, and the high today was $12.29. So they opened at 850 and went right up. They didn't even go low. That was a low, and then went to $12.29. But they only did that because you got support here. And that's a good trade to have up and out of the money, especially when you got the weekend, you got the debt ceiling. Hey, this thing could go either way. We were already in the put options because we were saying and doing the transactions up here. So we're already making a lot of money. So by buying the call, we can't lose any money because we're weighted right at the right time, meaning that we took the right side of the trade. That was the put side of the market on the S&P when this was failing. Okay? And I already showed that whole scenario here. And when this was going down, the calls made their highs, and they lost their value today down to 8.5. What a haircut people took on that. Then that's 1 day, 2 day, 3 day, 4 day. There's a 5th day. Today they got support, and how you got support here on the S&P 500 index. What makes it, look at volatility is volatility. You have to have both sides, because I'm going to tell you why. There's too many headlines that are out here. Risk always has to be addressed with major U.S. history in play. But we are so close that the $1,300 call could not be held overnight. It would be executed. You can see the amount of contracts, 200 of them, so they're dumping into the move. But the 1330 call that we're talking about hedging volatility with here is that the reason why it's risky, because this if this goes into a daily sell signal right here, this little blue bar, what will happen is that we will come down and probably break the 200-day moving average, and you have to have a 1260 put below the market. And let's take a look here at where that 1260 put is, and let's see if it's inflated or not. Well, it's lows down here. Sorry, $4.80. The high is 20. So that's because they can go higher. They can go all the way back up here. If we go into a sell signal, this put option continues to go higher here, and you will come down, and if you go into a sell signal, you will break that 200-day moving average and get below it. Okay? And it's very important to understand that the call, the 1330 call, is you have to put the trade on against this put. Because if one gaps up, if this was to gap up here, the calls, and they were to gap the markets, and the S&P was to hold it, and all was turned out, hey, you would gap up here, but you would gap down in the puts, and then what would end up happening is you'd figure out what side to come out, and you would let this winner go. You can't lose any money. So the risk is being managed overnight with using an index option. And the thing about it is, because of the risk here of a daily sell signal, you have to have the put. And yes, this is down toward the bottom. You're not paying. It's not like you were buying up here and riding these calls down. You're getting them at the bottom. So you've taken a lot of dollar cost risk out by getting this wholesale. So your downside here is not, it's only $8 and, or let's just say $8.50 or $9. That's your downside. But over here, back to the 260 put below the market, is if we get to the sell signals and all of that, there's a $20 potential move up here. Okay? And you would make a lot more money. So let's say the contracts went to zero, paid $9, and then $9 went to zero. That would never happen, but say it did. But these are up here at $40. Well, you made a big move by having that put. So let's say you made, let's just use a number that's easy. So let's say you made $20 here and you lost $9 on the other one. That's, you're still net positive $11 between the volatility trade using calls and puts. That's a 260 put. Once again, the 1330 call up and out of the money. You lose the value here if you go into daily sell signal. That was the first test of the 200-day simple moving average on the S&P 500 index. The thing about it is you would break through it. The last previous lows over here from that bull rally are at extreme high jeopardy of cutting it and going underneath it and continuing to sell through it. And the reason why, we're marking it at 7/29/2011 at 12:23 p.m. Pacific Standard Time on a Friday, going into what? A big-ass weekend. So, in the short term, headline economic event is going to cause a huge gap up, a gap down, a sell signal, trade management using calls and puts on the S&P 500, and how to address risk using indexes, and not only that, understanding the leadership components on a daily level that either is selling. If they're selling, you'll know why the index is going to break down. Today, we showed the individual names in the S&P 500, the price lines, the apples, everything that was being bought. Those stocks is what gave the knife hook support here. And we will continue this subject on Saturday.